Hello, everyone. I'm sure you're all keeping safe and concentrating on your studies and got some time to recapitulate our previous discussion on the ratios analysis. And today we will be talking about another important topic, that is cost of capital. And this holds a very important foundation on various chapters, like capital structure, investment decisions. So that's very important that you guys spend some time in reading the study material, understanding what is cost of capital, and application of the same, relevance from a corporate standpoint. So it holds its significance in practical world, and of course for your examination purposes it's very important because the concepts you will learn here, that will be definitely useful for other chapters as well. Okay, so first let's understand that what exactly is cost of capital. I think the most important misconception generally students get onto this one is that when we talk about cost of capital, are we talking about that you know if we are raising a capital from some source? For example, we can raise a capital through equity, or we are raising capital through a bank loan or a debt. They what we need to pay them in return. So is it that the cost of capital? So uh, you may be thinking the right direction though, but we need to all understand that the cost of capital is generally construed from the context of expectations of the capital provider. So there could be different sources of capital. I'm sure you will be doing that in the capital structure. But yes, whether it could be equity shares, preferred preference shareholders, or the lenders or banking institutions. So all that, the could be a different source of capital providers, and their expectations determine what is the cost of capital. So it's very important that it's not the amount which the company plans to pay or actually pays, but rather the expectation of the stakeholders. So that's what cost of capital is. See, guys, you need to understand that you are raising capital, right? Any form, equity, debt, loan. You raise capital in any form, but nothing comes free of cost, right? So if someone is kind of investing funds, think from an investor's perspective, step into their shoes. They are investing funds in your business, and they have certain expectations, right? They would have a certain opportunity cost. They would have invested the same amount of funds somewhere else. So having said that, they have certain expectations in return, while they are investing some capital. So that's why we need to understand, what is the cost of capital. Now let me ask you a question that, if you are given various sources of capital, what role the cost of capital may have in deciding which source of capital you should opt for. For example, if I want to expand into my operations, and I have two or three different options from which source I need to raise the capital, what role will cost of capital play in that decision? I think you're bang on there. We're talking about the source which either provides a lower cost of capital, or maybe any combination which could provide a lowest weighted average cost of capital. So the idea is, see, it's always a seesaw puzzle, that from an investor perspective they would want to maximize their returns. From an organization perspective, you want to minimize the cost of capital. So we'll be talking about from an organization perspective in this chapter. So, what are the factors that are very important that are considered for understanding the expectation of those stakeholders? So, generally the factors are, of course, what is the actual amount you're receiving? What is the corpus you're receiving, right? And what in return you will be paying them, or what is in return they will be expecting from you. Those are the two major factors that will be considered. Also, it's very important that we need to understand that this cost of capital will be playing a very important role in other chapters as well, like investment decision, as told you. It will also be known as some other terms like hurdle rate or opportunity cost, as I said earlier. And of course, it will help you not only to determine the capital structure, optimum capital structure, but also your financing and investment decisions, right? So the rule of, cost of capital will be in all those domains. So the finance manager role becomes very important in this context, because they have to balance out, right? As I said, that expectations of the investors will be to maximize the returns, and of course the role of the finance manager will be to form a capital structure which is a minimum, having a minimum cost of capital. So somewhere we have to strike a balance over there. So the most important point on this particular slide is, the application of the cost of capital in certain domains like financing decisions, like, which capital structure components, we're talking about investment decisions, which we'll be talking about in capital budgeting. And of course, your any kind of a credit policy also is very, very important. When we'll be talking about towards the end of your lectures, we'll be talking about the working capital management. There also will be using the cost of capital. So let's start and understand, what could be the different sources of the capital. As I said, you can see equity shares, that's your owner funds, preference shares, debentures, also known as bonds, could be loans from the financial institutions. So we'll be talking about the cost of capital of each of these resources one by one. And of course, towards the end, we'll also talk about the weighted average cost of capital as well. Okay, so guys, let's start with the first topic from the cost of capital. That's cost of long-term debt. That's the first source we're talking about here. Now, guys, very important factor. Couple of things I need to touch base upon when we talk about equity versus long-term debt. Generally, we construe that that long-term debt is a lower, or rather lesser costlier affair than the equity. The reason being, in terms of the debt, the, the cost associated with the debt is called interest, right? Interest on debt. And that interest is generally tax deductible. So that means it results in a lower cost of capital. Whereas in terms of equity, the equity shareholders, they may have higher expectations in terms of opportunity cost, and the dividend the organizations need to pay to them is also not tax deductible. So that is a general perception, which is true also to an extent, that the long-term debt are kind of a lesser or less costlier state of affair than the equity. Although from a riskiness attached, that you will be talking about in the leverage, you'll be studying in the leverage chapter, where too much of debt could be a risky affair, and equity may not be that much of a risk, because we also talked about in the solvency when we talked about the ratios as well. So let's talk about how do we calculate the cost of long-term debt here. Now, we need to know what components do we need. As I said that, what is the amount of, amount you are getting, how much you need to, pay, what are the expectations of the stakeholders. So the different wordings or different factors are obviously the face value. Generally, you can have a different face value of instruments, like a face value of 100 rupees, or you have a coupon rate. Now that's something, in the debt agreement, what is the interest percentage mentioned? That's called coupon rate, right? Issue proceeds generally could be less than face value, could be more than face value, depending on whether the debt is, or the bond is issued at a premium or a discount. But of course, that is adjusted with any kind of a flotation cost. You may have other factors to be taken care of, like your tax benefit, your redemption value. Now it depends on whether my debentures are redeemable or irredeemable. Generally, from a practical standpoint, more or less the debentures are redeemable in nature. But in case the debentures which are irredeemable in nature, that is, they are not redeemable during the company's lifetime, so the cost of debt for those debt is again is interest net of tax upon net proceeds. Now that's very important here. A couple of factors I need to talk about. Once we are talking about the numerator here. Now, in the numerator, we're talking about interest net of tax, and as I said that tax, from the tax perspective, interest is provides you the deduction, right? So interest is tax deductible. That's what I mean. Now, and that's why the real cost to the company will be net of tax, because that interest is resulting in a lower taxable profit and hence lower tax outflow. So with the quantum of the interest, your tax outflow gets lower. And because of that, we're talking about here in this case is less of a cost to the company. So that's why in the numerator you're seeing that interest into 1 minus t. So let's spend a minute to understand what exactly we are trying to say here in terms of context of the tax benefit. Let me just share my whiteboard with you. Okay, so let's say there are two scenarios here, scenario 1 and scenario 2. Okay, let's say my revenue is 1000 minus costs. So you have a gross margin here. Okay, and after gross margin, we're talking about SG&A and other operating expenses. Let's say that's 200, and let's say this is your 400. So I'm taking a similar example here, and the reason being, let's say a scenario 1 is having a bit of a debt here, and scenario 2 there is no debt. Now this terminology, or we are using this 400 as earning before interest and tax, EBIT. Okay, so let's say that there is an interest here and there is no interest here. And so this is your earning before tax. Let's assume that the tax is 30%. So this is 90, this is 120. So that's your profit after tax. Guys, have you noticed something? When we talk about this interest factor here, so interest cost apparently seems to be 100 here. But guys, just see that because of that, my tax expense has gone down from 120 to 90. So I have an interest expense that's of 100 here. Also, I have a tax saving of 30. That brings down my net interest expense as a 70 here. So that's why when we are saying its interest is tax deductible, of course, the formula we were using in the numerator was interest into 1 minus tax. So how come that is true? 100, 1 minus 0.3, that's 70. Hence proved, right? So I hope that is helpful to you all to understand why we are using that in the numerator here. Okay, guys, so coming back to our presentation here. So on the numerator, as I said, we are having a I into 1 minus t, and look at the denominator. So it's the basis what we are receiving. What is net proceeds? What is NP here? Okay, let's talk about that as well. Now in this case, NP depends on whether it's a new issue or it's an existing issue, guys. So now we are talking about NP here. So NP represents to net proceeds in case of a new issue, but if you are calculating the cost of existing debt, then we are not using the net proceeds, rather we are using the market price, here. And that depends on whether you are calculating the cost of capital for the new issue or the market price. The simple way to remember is that new issue, maybe some flotation costs along with that. So net proceeds, existing debt, why to incur any flotation cost? Okay, you're calculating the cost of capital. Okay, how much that is trading in the market for, or what's the current market price, and that's the logic there to remember, right? So let's take an example here. 5 years ago, Chandi Limited issued a 12% irredeemable debentures. Mind you, irredeemable. We are talking about irredeemable first of all, right? Irredeemable debentures. So at 103 at 3 premium. Now guys, it was 5 years ago. It was 5 years ago, mind you, 5 years ago, right? So the current market price of these debentures is 95. So 5 years ago, so the net proceeds would have been 103, whereas they're not given any flotation cost. But do you need a flotation cost? No, because you are asked for the current cost of debenture capital for the existing debt. And if that is the case, you just have to ensure that 12 is your interest, 1 minus tax rate, 1 minus 0.35, and that's your current market price is your 95. That's what you need to calculate. And hence, accordingly, your cost of debt in this case becomes 8.21%. So I hope that makes sense to everyone here. And we need to be careful that yes, whether we're talking about the irredeemable debt and or also we are needing to take from a denominator perspective, whether we're talking about new issue or we are talking about the existing debt. So we need to take a current price in terms of the existing debt, guys. Now, what happens if my debentures generally are redeemable? Now, we calculate the cost of long-term debt that could be redeemed either at maturity or earlier. Now, the formula for that is a little slightly expanded formula here. We still use 1I minus 1.2 in the numerator. We also add a spread of the difference between the redemption value and the net proceeds. Now, the redemption value and net proceeds could be different, right? So, and also it depends on we are talking about like net proceeds, whether you're talking about new issue or the existing debt. So NP could be a current market price as well in case we are talking about the existing debt here, right? So basically, what we need to understand that we are kind of spreading that difference over n. What is n here? N is the remaining life of debentures. So over the life of the debentures, we're spreading that difference, redemption value and net proceeds. So whatever the difference is, you spread that difference along with the interest because you kind of, that's also the cost to the company, right? So whatever difference or cost or the savings. So depending on whether my redemption value is more or less, right? So RB minus NP upon N, that spread is added to my interest into 1 minus T. Now what is interest into 1 minus T? That's interest net of tax, right? So, and you divide that by average price. Average would be redemption value plus either of the net proceeds or the current price. So that's the average RE plus NP upon 2, guys. Now that's important. We need to understand. Now, generally, we may not see that, if you're talking about, discount or premium may or may not be tax deductible. But if that is the case, if the discount or premium is also tax deductible, then, we may not, we ignore, or rather we actually spread the entire tax benefit on the entire numerator, because generally the difference between RV minus NP could be, of course, your premium or discount, right? Those are the two possible scenarios. And if that is the case, if that premium or discount is also tax deductible, then it's not only I into 1 minus T, but it also is RV minus NP. That spread would also be multiplied by 1 minus T. So we take 1 minus T outside, and you add that spread to the interest cost, and we divided that with the average. So again, we need to be very much careful here. We're talking about redeemable debentures here, right? So let's look at illustration for the same purposes. Now, the company issued a 10,000 10% debentures of rupees 100 each at par on 1st April 2012 to be matured on 2022. See this. This is not irredeemable debt, right? Now, company wants to know the cost of its existing debt. It's redeemable debentures and existing debts. So we know existing debt. Why this is important for us? Bang on. We are talking about a net proceeds, not net proceeds, rather current market price when we're talking about the existing debt. And that's what given to us on 1st April 2017 when the market price is given to us as 80. So, and again, we're talking about an existing debentures assuming 35% as a tax rate. Now we know that 10% interest, so we are calculating interest into 1 minus t, that's 1.1 minus 0.35. And of course, we're talking about the redemption value. Now we're talking about how much will be the redemption value for this, right? So the market price is 80, so redemption value would be at par. That's again to be matured on 1/4/2020. So we're talking about 100 minus current value, that's 80, and we're talking about 2022, right? So how many years do we have? 5. And we spread that, we kind of average that out with the calculation of the working, or rather redemption value plus net proceeds upon 2, as an average of whatever the cost is, right? So basically that comes out to be 11.67%. So there are two important things in that particular example. One is that we need to understand that it was a redeemable debenture, and also the fact that it is an existing debt. So in NP, that refers to your current market price. So that's what we are using here. And also they are nowhere mentioned about any difference to be tax deductible as well. So we're kind of ignoring that. We are only ensuring that the interest is tax deductible. So I hope that is clear to all of you, right? Now, there is another method here when we calculate, guys, we're talking about the cost of redeemable debentures using the yield to maturity. Again, that is, again, we talk about what we how we calculate that. We discount the relevant cash flows using the IRR. So we need to understand an IRR method here, that anyways we will be talking about the similar formula in the investment decisions and capital busting chapter as well. So yield to maturity, what is this? This is the IRR at which its internal rate of return at which the current price of a debt is equal to the present value of all the cash flows. So what are the different cash flows, right? Time period 0, it will be the proceeds in case of new issue. And you are rightly imagining that in case it's an existing debt, it would be a current market price. And during the life of the debt, guys, will there be any cash flow during the life of the debt? Definitely there will be interest payment, right? So interest, but we'll be taking net of tax because that is a tax deductible. Who knows better than you, right? So interest net of tax, that is something we'll be taking as during the life of the debt. And of course your redemption value will be, of course, at the time of maturity here. So basically there are a few steps involved here. The first, we are identifying these cash flows here, right? And of course then we need to discount them, because see, IRR is nothing but the current price of a debt is equal to the present value of the cash flows, right? So that's what we are talking about. Now how do we calculate the IRR here? Now, that's the final step. So let's take an example here. So company issued a 10% debentures of 100 each on 1st April 2013 to be matured on 1st April 2018. Company wants to know a current cost of its existing debt, and the market price is given as 80. Cost of existing debentures, again, to be computed here, assuming the tax rate as 35%. Now, guys, again, we need to identify the cash flows here, right? So 10% into 100, that's your 10, and there is a net of tax of 35%. So actual tax deductible or actual interest net of tax would be your 6.5, right? 6.5. Now that's one. Of course, how do we calculate this NPV? So let us quickly refer to some workings here. So in the same example, as you can see on my screen, you have originally, again, we are using, again, it is again an existing debt. The market price is 80. So we have taken as a 0 period. 6.5 is a minus in number every year. That's a 6.5. Now, and at the end of the maturity period, or we're talking about 5 years later, the value, redemption value is 100 here. So that's again a minus. Now, guys, the formula for IRR, now we will be spending a lot of time here. The formula you can see on the screen is, again, we have to calculate. So the key point here is we have to calculate NPV at two different rates, one of which should give us a positive value, another may be giving it as a negative value. So we need two discounting rates here. Now, guys, what is your guess? Will it be a higher discounting rate giving a negative value, or a lower discounting rate that could give a negative value? Let's see that. So in this case, we are seeing here that there are at, let's assume that a 10% discounting factor. Now, a 10% discounting factor, what we are getting here is as a value of a minus 6.74. Now, how did we calculate that? 80 is the initial cash inflow. That's a positive number, right? And 6.5 is the annual. We multiply that with the annuity of at 10%. On the extreme right hand side, you can see how we calculate the annuity. So all the present value factors, we add them up and we get as a 3.7907. So the one which I'm just highlighting in a blue here. Okay, so we add them up, so we get that annuity number. So we multiply that, because that number, that 6.5 is same across all the 5 years. So we can use the present value of annuity there. And also we calculate that this 0.62092 or 0.621 in nutshell to multiply the fifth year. So now this is an inflow initially and outflow later on. And that's why we are getting a negative number. And this will be again for getting another value at a positive number. We have assumed that discounting rate is 15%. Now at 15%, NPV is 8.51. 8.51. You may wonder that when we'll be talking about in the capital budgeting though, guys, you need to be careful. In capital budgeting, it will be outflow first and inflow later on. And there generally you will see that a lower rate may give you a positive number and higher rate will give you a negative number. So don't get confused. I'm just telling you that in advance, that here you can see a lower rate is giving you a negative number, higher rate giving you positive, because it's inflow first and the outflow later on. Now, what is the formula for IRR? It's a lower rate plus NPV at lower rate upon NPV, difference between the NPV at lower and higher, multiply the difference between higher and lower rate. So that formula you need to remember, guys. It's also, you could calculate IRR using a hit and trial method, but now this is the most approximate number which helps you to calculate the IRR. Now, when we apply these values over here, we get 12.21%. So when we apply these values in this formula, we get 12.21%. So guys, so again, I'm moving back to the presentation. So we need to understand, we need to know what is the formula for the IRR here, and that is not going to help you in the cost of capital, but also will be going to help you in the investment decisions when we'll be talking about capital budgeting as well. So that's again using the yield to maturity. Again, I'm repeating. The yield to maturity is the IRR at which the current price of a debt is equal to the present value of all cash flows. So that's again, so it's again, we'll be talking about IRR in the capital budgeting, where the present value of inflows is outflows, right? And that's what we are talking about here. Current price equals to the present value of the cash flows. Now that's again another way of, again, we talk about value of a bond that's amortized or rather repaid in installments. Now that's another scenario where we kind of calculate the cost of capital if the scenario is that your outstanding principal gets reduced. Now what happens is, if your outstanding principal is reduced, guess what will be the consequence on the interest payments? Now, if there is a bond which is kind of redeemed, repaid in installment, your outstanding debt gets reduced. And if your outstanding debt gets reduced, of course, interest will be computed on the reduced outstanding amount, right? So you will have a different amount maybe, and you have to maybe discount each with a different, discount each reduced amount separately, right? So the cash flows will be uneven in short here. So the few important points, that your outstanding principal gets reduced as the annual payments are made. And of course, the interest will be computed on the remaining balance. And of course, the cash flows will be uneven. Now, to understand this, let's see, and let's take an example here that your M&M is proposing to sell a 5-year bond of 5,000 at 8%. And again, a rate of interest per annum, and the bond amount will be amortized equally over its life. So they have to calculate the bond's present value if he expects minimum 6% return. Okay, that's what they're talking about. Okay, so that means they're expecting a minimum rate of 6%. So how do we calculate this? The value is again we need to calculate what is the cash outflow every year, and we discount that, and that will be actually helping us to calculate the value of the bond. So we're not talking about calculating the cost of capital, rather we are calculating the value of the bond in this case, right? So let's take an have a look at our workings here for this particular question. So if we see this particular example, in this case, my opening outstanding is of 5,000. And as was given in the question that your bond will be amortized equally over its life. So that's the point which is clearly mentioned. So my outstanding balance will be reduced by 1,000 guys. So 5,000, 4, 3, 2, 1. And the interest was clearly mentioned as 8%. 8% interest, again my interest also gets reduced 400, 320, 240, 160, and that needs to be added with the principal because that's the annual amortization or annual repayment. So my total outflow every year will be a reduced outflow because of the reduced interest, 1400. How come we are arriving at the total outflow guys? 400 plus 1000 gives you 1400. 320 plus 1000 gives you 1320. 240 plus 1000 and so on, and we discount that again at a factor of 10% here to calculate the bond's present value in this case. So the idea is in this case you may do a discounting at different rate depending on what exactly is the value here. You may be discounting at a expected rate of 6%, 10%, and so on. But the present value, the crux of this is the present value of the bond here is calculated based on the annual cash flows. That's interest plus the principal repayment. So your 1400, 1320, 1240, 1160, and 1080. So we discount that using an appropriate discount rate here, and will give you a value of that bond. So that's very important guys, that we need to understand, we need to you know wherever we need to calculate the value of the bond, and where we are giving this could be also a scenario actually, that just imagine that in this case there was no annual payment maybe, but only the interest payments was there. Then the scenario would have been repayment at the end of the majority of the bonds, right? In that case also, if I would have been calculating the value of the bond today, I would have been discounting exactly in a similar fashion. The only thing is my principal would not have been an outflow every year. That's the only difference that would be there. Otherwise, the pattern remains the same, right? So that's about it. And now we are talking about another factor for a cost of convertible debentures. Okay, so what is convertible debentures? Now these are the bond holders or debenture holders. Now they have an option that they can get their debentures redeemed into a certain number of equity shares, or they can also get converted into cash. So what is the convertible debentures here? These are the holders which have either an option of debentures redeemed into the cash, so it's more of a similar like a redeemable ones, or get in lieu of the cash, they get a number of company shares. So generally, when we talk about convertible, we refer to the convertible into the company shares. Now, that's why we are saying that because there is an option of redeemable shares and also the not redeemable shares, but convertible to the shares and also redeemable into cash. That's why we are saying that these debentures are kind of similar to the cost of redeemable debentures. The assumption here is that all the holders will choose to convert. So basically, if we're talking about redeemable debentures, so we use the same formula, and we need to be careful that yes, the assumption is that all holders will choose to redeem here. Now let's take an example here. Company issued 10,000, 15% convertible debentures of 100 each with a maturity period of 5 years. And at maturity, the debenture holders will have the option to convert debentures into equity shares, the ratio of 1 is to 10. Now, the current market price is of the equity shares is 12. Historically, the growth rate of the shares are 5% per annum, and we have to compute the debentures cost of capital assuming 35% tax rate. So guys, in this case, we need to be careful that, of course, we're talking about the convertible, and we are seeing on the top that it's similar to the cost of redeemable debentures, right? Similar to the cost of, and we know what is the formula there. What is the formula there, right? The formula in the case of the redeemable debentures, we just discussed again, I into 1 minus T plus RV minus NP upon N divided by RV plus NP upon 2. Now, in this case, the only catch can be slightly different. That is something which we need to calculate what will be the redemption value. Now, imagine you're talking about 1 is to 10 here, right? So 10 shares for each debenture. So we take talking about the current market price of the shares is 12, and historically the growth rate of shares are 5% per annum. Now we need to calculate what is the redemption value that means. And guys, we're talking about maturity period of 5 years. So we need to understand the redemption value in this case is this. When you're talking about redemption value, so that's very important that you have a 5 years. So that 12 value will be again increased or rather compounded by 5% every year, and that multiplied by 10 will be your redemption value, because mind you that you are having a 10 shares for each debenture. So redemption value is a trick here, right? So we're calculating the after 5 years what will be the value of the equity shares. Today's market price is 12, so 12 into 1.05 compounded for the 5 years, and that multiplied by 10. So my redemption value in this case becomes 153. And of course, rest of the formula, guys, remains the same here. So you're talking about interest that is tax deductible. So interest is 15%. So we calculate 15 multiplied by minus 1 minus 0.35, and you kind of spread that 153 and 100 difference over 5 years and divide that by the average. So you get a 16.09%. So guys, I think sounds a little easy this one, but we need to be just careful that redemption value could be tricky here, right? When we're talking about the convertible debentures. So that's all about debt, guys. So just quickly, let's recapitulate whatever we have discussed in the terms of the cost of debt here. Now it could be irredeemable debt, simple formula. We're talking about I into 1 minus T upon NP, depending on it's an existing one or the new issue, the NP can be defined. Then we talk about the cost of redeemable debt. There you're talking about the spread between the redemption value and the net proceeds, depending on the premium or discount factor. Be careful of the tax deductibility. We calculated the yield to maturity value. We calculated the value of the amortized bonds. And also now we calculated the cost of convertible debentures. So small points, but we need to be careful that we study them all and remember that, right? So we need to be, who knows what kind of a question comes up and pops up in the examination here. Now the next point here, we're talking about cost of preference shares. Now guys, what is the nature in terms of the expectations when we are issuing any preference shares? What do you think? So in terms of preference shares, the returns expected by the preference shareholders is dividend. Now, as far as the type of capital structure, the source of capital structure is concerned, now these preference shares, as the name suggests, we're talking about the term preference here. So now these guys have some preference over what? They get priority over equity shareholders. But mind you, being a dividend, which is an appropriation of profits, it is not tax deductible. And that's why the cost of preference share is generally, kind of could be more than the long-term debt, because those are the guys, the interest was tax deductible, right? Now, how do we calculate the cost of redeemable preference shares? Now, it's similar to debentures, but the difference is that this is not tax deductible. So if you look at the numerator, guys, the preference dividend, there is no 1 minus T here. The preference dividend is not tax deductible. Please remember that. So it's preference dividend plus the spread upon N and then the average value of the redemption value and the net proceeds. So what's that spread again? Redemption value and the net proceeds could be your, again, the difference could be due to any kind of a, the premium or discount or any kind of other issue cost. So that could be anything, right? So that's spread divided by n is of course the remaining life of the preference shares. So again, here the net proceeds is again, could be in case of a new issue, you kind of reduce the flotation cost or the issue expenses, and of course, otherwise it could be the current market price, right? So important note at the bottom of the slide, so it's issue price less issue expenses, but if you don't have the issue price, again, you can assume that to be current market price. But guys, if you are required to do or kind of give any assumption or take any assumption for calculation, just please mention that, right? Then we're talking about an illustration here. Again, let's understand how do we calculate. Although it's very similar to what we just discussed for the debentures piece, right? So in this case, again, the XYZ issues 2010% of preference shares of 100 each at 95 each. The company proposes to redeem the preference shares at the end of the 10th year from the date of issue. So calculate the cost of the preference shares. So what do we have here, guys? When we have to calculate the cost of the preference share in this particular example, let's try to understand what exactly are we given here, right? So our cost of preference shares, so we know that is my preference dividend plus my RV minus NP, that is divided by N, and then we can divide that by the average of these two values. So what is my preference dividend? Now 10% preference shares, right? So my face value is 10. My redemption price is again, will be my maturity value unless until specified something else. And my price right now, it's we're talking about 95, right? So here in this case we have issued that for 95, so new issue here, so 100 minus 95 divided by 10, and that 100 minus 100 plus 95 divided by 2. So what does that come out to be? So we're talking about 10 point, so it's 5 upon 10, right? So 10.5 upon calculating as 97.5, right, multiplied by 100. So that's will be giving you 10 point roughly 7% here. So when we're calculating, again, just be careful that again it's better that we calculate that on the two decimal places. So 10.77 it comes, right? So I hope you understand again the similar approach what we kind of calculated earlier. So your 10.77% would be the right answer in this case, right? So very similar to the debentures though. However, in case of the irredeemable preference shares, again, it's kind of a similar to the calculation of the perpetuity cost, not to the similar to the cost of the debentures here, because in this case, what's happening is, again, as I said, that it's not, again, it's not deductible or it's not tax deductible. So the formula could be very similar here. We talked about NP in terms of the irredeemable debt, but here it's preference divided upon the P0. Now P0 is again net proceeds in the case of issue of the preference share. So again, let's take an example in this case. If our energy is issuing a preferred stock at 100 per share with a stated dividend of 12% and a flotation cost of 3%, then calculate the cost of the preference share. So if we simply see my dividend is 12%, that's 12, and my P0 in this case is 100 minus 3, so 12 upon 97 could not be more easier than that. So 12.37% would be my cost of preference shares here. So that's, we talked about till particular point, we're talking about the long-term debt, we talked about the preference shares, and the next piece is very, very important, cost of equity share capital. This section and the cost of retained earnings, guys, is very important for us to understand. Okay, so what is a cost of equity share capital? As I said when we started our discussion, when we said that what is cost of capital, it's all about the expectation, guys, not what we are supposed to pay in return, because if it was to pay in return, there is no statutory liability, to pay back equity shareholders unless and until we are, declaring the dividend. So it's all about the expectations of the stakeholders. In this case, who is the stakeholders? It's the equity shareholders, guys. Now, it is the expectation of the equity shareholders of whatever they are investing in the company. And they, you can see that there are different methods available for calculating the cost of equity share capital. Now, it actually depends. It will virtually depend on what kind of information or, you may have in the examination that will decide, which of these methods would be applicable. So you need to be careful, what are the parameters given to us here, right? Whether it is a dividend price approach or a growth Gordon's dividend model or a capital asset pricing. So there could be different methods that could be applied here. So let's understand. So first two, which are the most basic ones, dividend price and earning price approach. Okay, so dividend price approach, also called as a dividend valuation. Again, here the formula is pretty much similar to what we talked about, like, a perpetuity formula, right? So we're talking about assumption there the dividend per share is expected to remain constant forever. So D is your expected dividend, P0 is your ex dividend market price. So that's your cost of equity. So it's very straightforward though, kind of a perpetuity from formula that, that's D upon P0. That's what we discussed about the preference share as well. Earning price approach, however, in this case, the point is that they are not calculating or they're not expecting in terms of dividend, but whatever is the earnings of the company. That means from an expectation perspective, they know the owners, the equity shareholders know that today or tomorrow we'll get that, right? So in the form of dividends. So the key factor is here, the investor expects a certain amount of earnings, whether distributed or not. I think this factor is very important, whether distributed or not. Now, in the dividend price model, the assumption was that dividend per share is expected to remain constant. However, in this case, the assumption is the earning per share will remain constant. The formula here is the EPS upon P. EPS upon P, not P0. But again, we're talking about a similar definition though. It's about the net proceeds here, right? So this is again an earnings price approach, right? Now let's take a question on the earnings price approach, guys. Firm is considering an expenditure of rupees 60 lakhs for expanding its operations. Given some information here, a number of existing shares 10 lakhs, market value of the existing share is 60, net earnings as a 90 lakhs. Compute the cost of equity share and new capital and of new equity capital, so existing and new, assuming that the new shares will be issued at a price of 52 and the cost of issue will be 2 per share. And if you look at back at the formula again, you can see E upon P. P could be market share price or net proceeds. So I hope you know by now when we are using net proceeds and when we are using the market share price. So let's try to calculate that with the help of the information given to us. And we know that we need to calculate this using which model, again, which method. So we very well know that's basis the information. It's the earning price approach, right? So we need to be very careful that which uh, method is given to us, or rather which information is given to us. Now in this case, we need to understand first in earnings price approach, again the formula we know is your EPS upon P, right? And we need to see there are two methods, or rather two aspects here, the new equity or the existing equity, because those are the two things which are expected, right? Now first of all, let's understand what is EPS. So we need to calculate the earning per share, guys. So what is EPS? It's your income attributable to the equity shareholders upon the weighted average number of equity shares, right? So in this case, what is the the income attributable to the equity share? So net earnings given to us. Now we can't take any other assumptions here. So 90 lakhs. So that's what given to us. And and the 10 lakhs is given to us as a number of shares. So that means my equity or earning per share is 9, guys. Now, basis that, we need to see whether we are required to calculate the cost of equity for the existing equity or new equity. Now, in terms of existing and new, what's the difference? In terms of existing, of course, the formula would be your EPS upon the market price. Here, my formula will be EPS upon the net proceeds. So accordingly, 9 upon what is the market price in this case given to us. Market price of the existing share is 60 here. So that means as 15%, right? And in case of a new issue, that was 52 is the issue price and 2 is the cost of issue. So 52 minus 2, so 9 upon 50, that gives you a 18%, guys. So we need to be careful, step-by-step approach, what information we have and what exactly we need to calculate. That will surely help you to solve those examples here. Okay, so 15% and 18%, that's what we are looking at. So I hope you understand. So that's a good illustration on the earning price approach though. Now, this is the model which is very, very heavily tested on the exams. There are two models out of these five. So I'm not saying that, we can't, we need to emphasize, but yes, all the five can be tested. But yes, the most important ones are the third and the fifth one, guys. So the growth model and the capital asset pricing model. So let's spend some time on the growth approach or the Gordon's model here. Now, in this case, we're talking about the few assumptions, all those models which were developed with the efforts of the research which was being done. So there are certain assumptions to ensure that these models worked fine. In this case, assumption is that, again, the dividend growth remains constant, like growth rate, right? The rate at which the dividend grows remains constant, and the earnings, dividend, and the equity, all in the share price, will grow at the same rate. So you can challenge that, what are these changes? So we are not there to challenge those assumptions here, because of course the models could work differently, behave differently if we change those assumptions. So we will work around, we'll respect those assumptions. Of course, the assumptions we need to have in our mind. Now, what is the formula here? Cost of equity is D1 upon P0 plus G. Now, what is the D1, guys? D1. Now, D1 is the expected dividend. Not only that, it's D1. D1. So, next expected dividend. So, if you are given D0, then we have to compound that with the growth rate, right? D0 into 1 plus G. That is D1. P0 again, could be your current market price, would be again, or if it's a new issue, that it's your net of any flotation cost. And G is your constant growth rate of dividend. Guys, this formula you need to remember. You need to remember, please. Okay. So again, so company has paid a dividend of 10 per share of face value of 100 each last year, mind you, and it is expected to grow 10% next year. Calculate the cost of equity. The market price here is 220 here. Now, the company has paid a dividend of 10 per share and is expected to grow 10%. So that means if you're talking about as a D1 is 10 into 1.10, 11. Are we talking about that? And what is my P0? We're talking about 220, right? And that divide, that with your growth factor to be added. So that means are we talking about a 15% cost of equity here? That's absolutely right. So we're talking about a 15%. So mind you, the important factor is to calculate this D1. 10 into 1.10, that's 11, right? So 11 upon 220, that's your 5%, plus your growth rate is your 15%. Okay, so now the important point also is, most of the times the growth rate will be given to us here, right? But in case we need to calculate, there are a couple of methods. Just for your knowledge, you should know that. Again, it would be an average method where we are talking about, growth rate that would be based on my current dividend and of course the dividend which was various years ago. So what we are trying to do is averaging out the rate at which dividend grew in recent years. So that's what we are trying to do here. So today, what is the dividend? What was the dividend n years ago? How far it has grown up? So depending, n of course represents your number of years, right? So we know that today's dividend, now it's look back 10 years back. Now this is today, current dividend guys. D0 is today. Now this Dn could be n years back. Now from n years back, we have to come forward, we have to compound that 1 plus g to the power of n. So this is what is the compounding here guys. So we are compounding that to calculate my current dividend here, right? So, and basically we know the current dividend in this case, we know the dividend n years ago. So we have to calculate the G in this case. And that's one method, averaging out, average method. Another is a Gordon's growth model here. Now that's interesting here. Now let's talk about that for a minute or so. Future growth rate is determined again with the, in this case, what we are talking about is we understand that any organization would not distribute all of their earnings, would not distribute all of their earnings. So that means they would try to retain some earnings and pay some dividend. Definitely that would be the approach. So in this case, again, the increase in the investment will happen because what you did not distribute the entire earnings. You paid some dividends, you held back some profit, your investment rose, right? By default, you plot back certain profits within the company. So that means with the sum of the earnings retained here, your investments kind of push up, and that would actually end up into a vicious circle. Now, if your investment base increases, your future dividends will increase. You you know plow back more profit, your investment base increases, you will pay dividends. So again, we need to understand that from a logical perspective, right? So let us see here, in case you have a horizon of this big, and out of this you can get let's say this much of return. Now if I am kind of plowing back some part of this into this, my horizon, my capital base will again become little bigger, and on that basis, if I am operating little efficiently, my returns will again increase, and so on. So this will go on again due to the retention here. So as and when we are retaining the part of the profits, my investment base is increasing, and on that investment base, if I am kind of perfectly utilizing my resources, that would result to increase in the future dividend. So basically, in this case, the growth rate on that logic is again the earnings retention ratio multiplied by the rate of return on the funds invested, because that is the rate at which the dividends will increase. That's the growth rate, right? So G is equal to B into R. So B is my earnings retention ratio, like how much you have retained. R is the rate of returns on the funds invested. So this specifically in talking about the portion which is retained by the company, right? So that's one. That's your growth approach, or the Gordon's model, where we're talking about either average method or the Gordon's growth model. Then another approach is a realized yield approach, where we're talking about an expected return is based on the average return of the return realized in the past. Now, the point is that it could be impractical. As I said that whatever. So in the average approach, the problem is that what we earned in the recent years, what was the growth rate in the recent years? Can we expect that the same trend will continue in the future? Especially in the current times, we know the answers, right? So we all need to be safe when we're talking about the pandemic, how it has kind of overturned the economist assumptions and all. So let's not go there. Although, but what I'm trying to say is that yes, it is a hypothetical assumption that what had been my growth rate in the past may continue in the future. Highly unlikely. So again, that's something which is again a impractical approach. So I think Gordon's model could still be considered, but yes, a realized yield approach or the average method may be criticized, but even the Gordon model is obviously based on certain assumptions, right? So again, so coming back to my cost of equity, again, we need to remember the formula again, what we are talking about here. Although they will be giving you the growth rate, but in case they don't give you B into R, is it right? B into R. And hypothetically, if they are talking about n years ago dividend and they're giving you the current dividend, then you can calculate based on the average method as well. Okay. Now, guys, the other method which we're talking about in this case is a capital asset pricing model. So, by the way, let me just go back to the list of methods here, guys. So, we're talking about the dividend price method. We're talking about the interest earning price approach. So, growth model I just talked about, realized yield approach, just the extension of that. So, and now we are down to the last method, that's the capital asset pricing method, right? So let's talk about the CAPM model, very, very important here. Now, in this case, again, there are different types of risk we need to understand based on this model. There are two types of risk against which any security could be exposed. Now, what are those risks, guys? Now, let us try to understand if you are trying to invest in the share market, uh, how do you think to diversify the risk? You may be able to diversify the risk by choosing different segments, industry segments like real estate, oil and gas, financial sector, IT, healthcare, something like that. Now, the risk that could be diversifiable is called as a unsystematic risk. Now, that's something you can work around, right? It doesn't impact the entire system. It's a company specific risk, guys. So the way to remember two types of risk: diversifiable, non-diversifiable. Diversifiable is unsystematic. Diversifiable is unsystematic. Why? Because it doesn't impact the entire system. It's a company specific risk. And the other type of risk, a security could be exposed where you can't do anything. That could be the entire system. That could impact the entire system. It doesn't remain a company specific risk. Non-diversifiable, systematic risk that impacts all the companies across the location. What are those kinds of factors, guys? Now, if I'm talking about company specific risk, company doesn't do good, company's operations fail, they're not ahead of their game. That's a company specific risk. So what do? You also invest somewhere else, right? So that's a diversifiable or unsystematic risk. Okay. And when we're talking about non-diversifiable factor or non-diversifiable risk, which is more of a systematic, the factors that could fall into that category could be any government policy. If there is a government policy, that could be there for the entire set of companies operating in a particular area, right? Or could be inflation or other factors. So one premise under capital asset pricing model is, again, they are focusing on rather the systematic risk factor, right? So again, so that's something we need to understand, because anyways, if it was an unsystematic risk, you could diversify that, right? So the cost of capital or cost of equity using the capital asset pricing model, guys, is the risk-free rate of return plus beta multiplied by the market risk premium. Now, what is this market risk premium, guys? Now, there is something called risk-free rate of return. What is that risk-free of rate of return? There is no risk attached to it, right? What could be the securities where you will have a risk-free rate of return? Mind you, you also need to understand there are two factors: risk and return. Generally go hand in hand. So if this goes up, this goes up. If risk goes down, the return may also be less. Now, if you're talking about the risk-free rate of return, that could be typically the government securities. So, of course, if it's a risk-free, the return will be also less. So, again, as I said, that CAPM use the systematic risk factor. Now, what happens? What is the kind of risk associated with the entire market portfolio? Now, Generally you would have a market portfolio, you will have a government securities. There will be difference between the two, right? Because the market portfolio will be impacted by the systematic risk that impacts the entire market, right? And that's what we need to understand, systematic risk and the CAPM using the systematic factor. This is what is important to interpret the RM here. Now, there is something called RM, that is your market rate. Again, in this case, we're talking about it's more of a market risk or rate of return on the market portfolio. RF is a risk-free return. RM is the market rate of return, again, return on the market portfolio. But there is a difference between a market portfolio and a risk-free rate of return. The difference between the two is called premium here, market premium, right? What risk you are taking over and above the risk-free securities. The difference is multiplied by the beta, and the beta represents the systematic risk. Beta represents the systematic risk, and the market risk premium is RM minus RF. So we need to understand KE, that is your cost of equity, is RF plus beta multiplied by RM minus RF. Please, there is a common mistake students generally do here. Question can directly give you the market risk premium. Please don't deduct RF again. Please don't deduct RF again, guys. Market risk premium is already RM minus RF. Generally, students kind of do a careless mistake over there. Please make sure that you don't get into that trap, right? So RF plus beta into RM minus RF is the formula here. RM minus RF is your market risk premium. But I think you need to understand the logic. So when we are talking about the formula, now guys, as I said, market risk premium, that means risk or return over and above the risk free, and RM is the return of the market portfolio, which is the risk that affects the market portfolio. Systematic risk, which affects the whole system. System ko hila dale, right? The whole system is impacted. Now that is multiplied by beta, which is the coefficient representing the systematic risk. So that makes more sense to understand the formula, right? So what exactly over and above you are getting, over and above the risk free multiplied by the systematic risk coefficient. So if again, so basically if you are operating in the more risky geographical area, let's talk about if you are investing somewhere in Uganda, in South Africa, right? So you may want a higher return because you're taking more risk over there. So there the market risk premium could be a little higher. Not only that, even the beta would be higher. So that would magnify the entire cost of equity, right? So let's understand with the help of illustration. Mind you, this particular method and the quadrant growth model both are heavily tested. Okay, so compute the cost of equity of IHJ Limited, whose risk-free rate of return equals 8%, firm's beta equals 1.5, and return on market portfolio is 12%. So looks to be a straightforward one. So 8 plus 12 minus 8 multiplied by 1.5. So it gives you a 14% cost of equity in terms of the capital asset pricing model here, right? So very important security market line I need to talk about with you guys is if you look at this security market line, uh, you can see that this security market line is actually a kind of a line which is showing you the cost of equity. And if you see the risk free rate of return here, the risk-free rate. So this particular line, as you go upward here, that means the security is up, kind of somewhere in the, kind of taking a larger risk, because larger risk is a more return, so that your market risk premium would be more broader. So this security market line is basically representing, the entire capital asset pricing model, right? And you can see that risk return relationship on the right hand side on the screen. As I said, the government securities, government bonds, the least risky. But if you're talking about the least risky in terms of returns, also the least return here. But as we go ahead and take more and more risk, whether it's corporate bonds or we're talking about preference or equity shares, returns may be more, but risk also would be also more. As I said, you guys be careful that you can see at the bottom here, we're talking about if the question is giving you the risk premium, that means RM minus RF is already given, guys. So please make sure you don't do that. You don't double count that. That's very important. So that's about cost of equity share capital. So let's take a 5 minutes break here, guys, before we start the last section of the cost of retained earnings. Uh, Once we discuss that, we'll be attempting few questions for practice. So see you after 5 minutes. Welcome back, everyone. So now we will start our discussion on the cost of retained earnings. So we have talked about cost of equity, and we're talking about in cost of equity. We talked about one of the models where we're talking about the earnings, right? So earnings based model. So where uh, we need to understand that, if we are talking about cost of equity, retained earnings is part of the cost, or the part of the equity itself. So we need to understand what is cost of retained earnings then. That's retained earnings, that's is that part of the earnings which is not distributed as dividends, right? So basically, it's the opportunity cost. It's an opportunity cost that's foregone by the shareholders, right? It's basically, instead of dividends, that the company has plowed back the profits within the organization for their maybe expansion or infusement of additional capital into the operations. So wonderfully defined here, it's the opportunity cost of the dividends foregone by the shareholders. Now, it's pretty much similar to the cost of equity though, but we need to understand whether cost of equity or cost of retained earnings would actually be same. No, may not be. See, when we talk calculate the cost of equity, specifically in the case of a new issue, right? So in the case of a new issue, there is a flotation cost, and with that, your denominator comes your net proceeds, right? So in that case, the cost of equity would be higher. So in case of a new issue, the cost of equity will be higher, cost of retain than the cost of retained earnings. So again, the point is we need to ensure that net proceeds is what we calculate for the cost of equity, but cost of retained earnings we will still use the current market value. So that's very important point here. Please note that. So we're talking about in case of a new equity, make sure for the KE we are using the net proceeds, but for KR we are using the current market value, because you are not incurring any flotation cost in case of retained earnings, right? So that's just a profit which is being plowed back, not distributed. Now, in case there are again no taxes and flotation costs, so your KRS KE, of course, as we talk about mention in the case of a new equity, of course the difference will be because of the higher cost of equity. However, if there are taxes and flotation costs given, then your KR will be KE multiplied by 1 minus T and 1 minus F. So that primarily relates to when they are giving you taxes, what would have been the case if they would have, let's assume or think from that perspective, if the company would have not retained these earnings or rather distributed these as a dividends to the shareholders, they might have invested somewhere else. So the cost of retained earnings, as it is defined as an opportunity cost, then it would mean that the dividend might be taxable. So we're talking about like 1 minus T, and that multiplied by 1 minus F. So if they would have invested somewhere else, right? So think from that perspective. So anyways, if they have given you the taxes and the flotation cost, so KR is equal to KE net of tax, net of flotation cost. So, and if of course there are no information about the flotation cost and the taxes, you just assume KR is equal to KE, except in the case of new equity here. So let's take an example of an illustration here. So in this case, face value of the equity shares of a company is rupees 10, while the current market price is 200. Company is going to start a new project and is planning to finance it partially by the new issue and partially by retained earnings. You are required to compute the cost of equity shares as well as the cost of retained earnings if the issue price will be 190 and the flotation cost is 5. Dividend at the end of the first year is expected to be rupees 10 and growth rate will be 5%. That's interesting. And let's see how do we go about this. So I request you guys just take a snapshot of this question, and in the interim, Let me take you to the whiteboard and let's solve it together, guys. Okay, just take a snapshot of this question, please, allowing you for a moment for the same. Okay, let's do this on the whiteboard then. Okay, so here the requirement, of course, in this case we are talking about the cost of retained earnings, whether we're talking about cost of equity is equal to the cost of retained earnings or not. So again, we need to understand what is my cost of equity in this case, guys. Now in this case, what we're talking about, calculation of both the aspects. We also need to understand that when we're calculating the cost of equity and we are talking about a word new issue in the question, that's very important. So if that is the case, of course we need to understand that in case of new issue, we know that it's about the denominator that gets changed. Also, when it comes to the cost of equity, which method do we apply, guys, here? So in this case, we are talking about a method which relates to your dividend. That's a Gordon dividend model, right? So let's first of all try to calculate the cost of equity then. That's the formula D1 upon P plus G. That's the formula we are using there, right? Now in this case, what is this P, right? This will be your net proceeds. So what will be the D1, guys? D1. Now, D1, of course, we're talking about, in this case, dividend at the end of the first year is expected to be rupees 10. So they've already given 10 to you guys. Are we supposed to calculate 10 into 1.5? That's what you are trying to do here? Absolutely not. Please don't do that. So D1, D1 is already given to you in the question. Please read that line. Dividend at the end of the first year is expected to be rupees 10. Be careful, guys. So they might trick you like that. So D1 is already given to you. So 10, and they're given you in this particular question is the 190 is the issue price and the 5 is the flotation cost. So again, 190 minus 5 plus 0.05, right? That's your growth rate here. So that means 10 upon 185. So if we calculate 10 upon 185, so we're talking about 0.541 plus 0.05. So it gives you a 10.41% in short. So 10.41% is your cost of equity, guys. But the call of the question was another factor, that was cost of retained earning. Now, again, as I said, cost of retained earning is equal to cost of equity, except in case of new equity. In the new equity, the only difference you need to do in this particular formula is your denominator, guys. You don't have to take net proceeds in the case of retained earnings. So the market value that's given to us is 200. So your D1, which talks about again your 10 upon 200 plus 0.05. So that gives you a 10% as a cost of retained earnings. So I think that's pretty much it, guys. So 10.41 and 10%. That's how you go about that. But I think the most important line in that particular question or illustration is the last line, which talks about the dividend at the end of the first year. That's what they have given to us, right? So don't calculate. They're already given you D1 here. So be careful, right? So make sure that you kind of don't calculate a D1 again, right? So you had your 10.41, yeah, that is it, and your KR becomes 10% in this case, right? Okay, so another illustration, guys. Here we're talking about cost of equity of a company's 20%, a rate of flotation is 5%, rate of personal income tax is 30%, and we need to calculate the cost of retained earnings. So I think they're given you some factors which I was telling you. So how do you want to go about this, guys? So in this case, they're given you the cost of equity, the rate of flotation. So you just have to multiply that, right? So we're talking about the 20 into 1 minus 0.05 into 1 minus 0.3. That's it. So 13.3%. Again, so couple of scenarios, calculate the cost of retained earnings. In scenario A, we're talking about D0 as 5, P0 as 50, and G as 5%. and and the second part is RF, beta, and RM. So who knows better than you which model to be applied for, right? So D1 upon P0 plus G, that's the question number A, right? D1. We need to calculate D1 over there, right? So D1 is 5 into 1.05, and upon P0 remains 50, so 15.5%. That's your KR is equal to KE. So this question basically it's more of identification of model, right? Which model you need to use. So Gordon dividend or capital asset pricing. So the second one is of course straightforward. So RF and beta. Make sure guys, in this case, there could be a scenario that instead of this RM, they would have given you the market risk premium. So if they give you market risk premium, then kindly don't do this. That's already given to you. Make sure you don't do that mistake, right? Be watchful for the factors given to you in the question though. Okay, guys, I and we have actually discussed all the sources of capital and the cost associated with that. We talked about the cost of debt, we talked about the cost of preferred shares, we talked about the cost of equity, we talked about the cost of retained earnings. Now the most important point, remember when we started the session we talked about the role of the finance manager, right? So from investor perspective, they want to maximize the return, but you want to minimize the cost of capital. So basically, you would like to go for that kind of a capital structure that your weighted average cost of capital is minimized, right? So what is the weighted average cost of capital? Now, in an ideal capital structure, you would want to have some kind of a debt, some amount of a preference share capital, some amount of equity, and maybe some of the retained earnings may also be there. So whatever the proportion they have, you calculate that proportion and multiply the respective cost of the capital and you arrive at the weighted average cost of capital, right? So basically what we need to do is you have to apply the weights to each component based on their proportion and then multiply whatever the cost of capital we calculated. So for debt it will be this, for the preference share capital, for the equity and the retained earnings. So W is your weights here, right? Now weights is very important that it could be based on the book value or could be the market value. Now we need to understand pretty good that if we're talking about weights are based on the market value, where we need to understand that the retained earnings, for retained earnings specifically, so market value of equity could be apportioned basis book values of the equity analysis. We'll talk about that. We'll be using that in the help of with the help of example though. So let's look at this illustration by the way. Calculate the WACC using a book value and or rather second part as a market value as a weight. Okay. Now, capital structure of company consists of 5 lakhs debentures with market price 105, preference shares, market price 110, equity shares. And additional information is given to us for debentures. They are redeemable ones. Preference shares, again redeemable ones, equity share, and the next year expected dividend is 1 with annual growth of 5%. You know what is that means, right? What does that mean? Firm has a practice of paying all the earnings. Firm has a practice of paying all the earnings in the form of a dividend here. Corporate tax rate is 50%, and we have to assume that the flotation cost is to be calculated on the face value. So guys, as we always do, please take a snapshot of the question and let's walk through the whiteboard. How do we go about this one? Okay, please take a snapshot of the same. In the meantime, let me open up the whiteboard. Okay, so let's talk about this one now. So we're talking about WACC. Okay, so guys, in this case, they're giving a lot of information and they have to calculate the WACC. Of course, we need to first and foremost, we have to calculate the individual cost components, guys, right? So guys, we're talking about redeemable debentures. So we're talking about the cost of debt first. So we all know what is the cost of cost of debt, KD. So in this case, we know that what's given into the question again. It's your 100 debentures. Again, we're talking about 100 per debenture, redeemable at 10% coupon. So my interest rate is 10, and the tax rate, which is we have tax rate here 50%, right? So 1 minus 0.5. plus, so you have a difference between the redemption value and the net proceeds. So what is that value given to us in this case? So we're talking about 4% flotation cost. So 100 minus 4, 96, right? So you are talking about redemption value minus 96. And that is what we're talking about. How many years do we divide that by, guys? So we're talking about debentures that should be divided by 10 years, right? So we're talking about a 10 redeemable at par, 10% coupon rate, 4% flotation cost, 10-year maturity. So that's 10 for us. And then we are talking about 100 plus 96 upon 2. Okay, so how much that comes for? So the numerator will be 5.4, denominator will be 98. So we multiply that by 100. So I guess we get it as a 5.51 percentage. Okay, so KD is 5.51. Next, we quickly move to cost of preference shares. So the preference shares, they are again redeemable at 5% coupon rate, 2% flotation, and 10-year maturity. So a similar discussion here, but 5% coupon rate, mind you, preference shares are not tax deductible. So in this case, we are talking about 2% flotation cost. So RV minus your NP is 98 because 2% is the flotation cost. Again, this is divided by 10 and this is averaging out. So this gives you a 5.2 upon 99. So guys, that comes out to be 5.25 percentage. So we calculate cost of debt, we calculate cost of preference shares. So let's move quickly to a cost of equity. Now guys, in terms of cost of equity, I told you there is an important line that was given to us, next year expected dividend. So D1 is already given to us. So D1 is already given to us, right? So that is your 1. So D1 is again given to us as 1. So we need to divide that by your net proceeds here, right, guys? So in this case, we are given 24 market price and you're talking about 4 as a flotation cost. So 24 minus 4 plus the growth rate, which is given to us a 0.05. So that comes out to be 0.05 plus 0.05. So that comes out to be your 10%, guys. So 10% will be your cost of equity. Now, which component is left, guys? Cost of debt is there, cost of preferred. So I think we are given just 3 components, right? So cost of debt, cost of preference shares, and cost of equity here. Now, the calculation had to be based on using a book value as a weight or a market value as a weight. And they're giving you a capital structure, by the way. So in the very beginning, so when we're talking about the capital structure based on the book value though, so that's where we need to be pretty much careful here. So in terms of book value, we're talking about 5 lakh debentures, 5 lakh preference shares, and 10 lakhs in equity shares. So simple 5 plus 5 plus 10. So that's a 20 lakhs. So we're talking about the book values. Again, we're talking about the debt plus preference plus equity. So we talk about as 5 plus 5 plus 10, 20. So when we calculate the WACC using book value, so we talk about 5 upon 20. So our that was 5.51. Similarly, we're talking about 5 upon 20 multiplied by 5.25, and then 10 upon 20 multiplied by 10%. Right? That's your cost of equity. So that comes out to be so that should come out to be around 7.7%. Okay. Now Looking at the second aspect, WACC, using the market value. When we talk about the market value, so what is the market value here, guys? So when we talk about the debt market value, so that was 105, right? So market value in case of a debt will be your 5,000 into 505, 105, sorry. So we're talking about this as a 525,000 in terms of preference shares. So they're talking about 110. So you have a 5,000 multiplied by 110, 5,50,000. And in terms of equity, market price is 20, right? So 24 lakhs. So 34 lakh 75,000. So you have their weights with you. Similarly, you can calculate your weights 5.25 upon 34.75 multiplied by 5.51. That's 1. Similarly, 5.5 upon 34.75 multiplied by 5.25. And accordingly, the third component would be 24 upon 34.75 into 10. So what I did was basically calculated the individual component earlier and I applied the market weight here, right? So the value would come around 8.6% in this case. So I hope this is clear to everyone. So we have calculated the individual cost components. Then we calculated the WACC either using the book value and using the market value. Okay, guys, so I hope that is making some sense here, and let's proceed and look at the solution, right? So we're talking about similar numbers here as well. Okay, let's talk about another concept which is called a marginal cost of concept here. Marginal cost of concept, that's very important, guys. Now, marginal cost, the name is itself talking about, what about in case we need to raise additional cost. So marginal cost of capital is cost of raising an additional cost of raising an additional rupee of capital, guys. So now to calculate the same, we need to understand and we need to apply the intended financing portion as the weights to the marginal component cost. And when a firm raises funds in the proportional manner and the components cost remains unchanged, there will be no difference between the average cost and the marginal cost. Although that is hypothetical. Generally, when you kind of raise some additional capital, there is always a concern of the flotation cost. Because of that, there will be always a little bit spike. Can you see that? So we're talking about a WACC at a particular point, and then when you kind of raise some additional financing here, your there is a spike in the cost of capital. So the idea is that there would be dependent on the the component cost again may be remaining constant up to a certain level and then start increasing. The reason being is that of course till a certain level you may have a cost, the retained earnings could be plotted in, right? So once you go for the fresh equity, then only it could be a additional cost. Now very important point anyways, guys, because what happens is that in this case we need to understand that the intended financing proportion, that means there could be like I may be interested in X portion of debt, X portion of equity, X portion of the preference shares. And mind you, in the equity we also include the retained earnings. So in case my retained earnings is, for example, I am using a retained earnings as an equity, till that particular point only preference and debt will be issued. But once that proportion or that is, I have an additional source of capital, that is a requirement to maintain that proportion, I may have to raise even the fresh equity, and that point will result a spike in the weighted average cost of capital. So guys, to understand this concept, let's try to look at an important question here. So let me just open that question for you. Okay, so what do we have here? Okay, so this is the question I want you guys to have a look. So Dhamaka Limited has a following capital structure examine, which is again considered to be optimum as on the 31st March 2019, right? So 14% debentures, 11% preference shares, equity shares. Company has a market price of 23.6. Next year dividend per share is 50% of year 2019 EPS. And the following is the trend of EPS for the preceding 10 years. So they've given you a trend for the preceding 10 years and which is expected to continue in the future. That's interesting. Companies issuing a new debentures carrying a 16% rate of interest, and the current market price of debenture is 96. Preference share is again it's 9.2, and with annual dividend of 1.1, and the company is in 50% tax bracket. So what you need to calculate is after tax cost of new debt, cost of new preference shares, new equity shares, assuming that new equity from the equity retained earnings. So this is the point, guys, I wanted to highlight here. New equity share, assuming the new equity from the retained earnings. And then on the second point, they're asking us to calculate the marginal cost of capital when the new equity shares are issued, and determine the amount that can be spent for capital investment before new ordinary shares must be sold. So that means we need to calculate the intended capital structure until the point of time we have enough retained earnings. We're not going for the new equity issue, but once we need capital in excess of that, we may have to go for the new equity. And that's what the point number D is: compute marginal cost of capital when the funds exceeds the amount calculated in point number C. So it's a very strategic question. Let's try to build upon this, and let's see how we want to go about this one. So this is definitely is an interesting question, and I'm sure we should go step by steps. Whenever we look about any kind of a lengthier question, it's always a scenario that try to go step by step, right? So let us try to solve this together on the whiteboard, and please, if you want, as I always say, can you just take a snapshot of this given information only? Just take a snapshot of this given information, and then we'll go step by step. I will read out the question and we'll calculate that together. Okay. Okay. So I'm just giving you a moment to take a snapshot of this question, please. Only the facts. You can take a snapshot of this one, and then we'll solve the requirements one by one. So whenever there is a tactical question, it's always better to understand that by a step-by-step approach. So let's try to go about this. So marginal cost of capital. So this concept is very interesting, very close to my heart, but let's see if you guys can spend some time and read through what are we meaning by intended capital structure, till what point a fresh equity may be required. So those are very, very important aspects to be considered here anyways. So guys, the first question was calculate the after-tax cost of new debt, cost of new preference shares, and new equity share. That is the requirement of the first question. So let's calculate here. So the first one, that's question number A. So in this one, we have a cost of debt, guys. So based on the information given to us, so what exactly would be the cost of debt here? So we're talking about 14% debentures, right? So that's what we have, 14% debentures. So how do we calculate that? Now, mind you, their company has issued new debentures carrying 16% rate of interest. So the 14% debentures is their existing capital structure. So when you're talking about the cost of new debt, the call of the question is cost of new debt, not the existing one. So the new debt, the rate of interest will be 16%. And have they given a tax rate? Yeah, they have given 50% as a tax rate. So 16 net of tax 1.05. And what about the denominator, guys? So the denominator, of course, is your the current market price. That's your 96. So company issued new debenture. So what is the cost of new debt then? 16, 1 minus 0.5, because 50% is my tax rate, 96. So that will be your cost of debt. So it's 8 upon 96, guys. 8 upon 96. That gives you, I guess, 8.33%, right? Let's move to the second point. Now, the second call of the question is cost of preference share capital. Now, cost of new preference shares, right? So preference share 9.2 with an annual dividend of 1.1 were also issued. Company's 50% tax bracket. Wow, do we deduct tax on the preference dividend? No, preference dividend is not tax deductible, guys. So kindly don't do that mistake here. So we know that we have a preference dividend. We know that we have a market price. So 1.1 upon 9.2, that's given to us. So what is my cost of preference share capital? So 11.96%, right? Or maybe we can calculate as a rounded off to 12% as well, right? So third point is your requirement. Mind you, we're just in the question number A here. New equity share, assuming new equity from retained earnings, guys. So assuming from retained earnings. So that's what given to us, right? So if you look at the information here, we need to understand, are we talking about if it's coming from retained earnings? So that means somehow we need to understand that, we are talking about, you know, uh, the source of capital which is given to us, that is KR is equal to KE. We know that, right? So let's calculate KE anyways. So for the KE, what we have given to us is that company has a market price of 23.6. Next year dividend is dividend per share is 50% of 2019 EPS. So next year dividend is 50% of 2019 EPS. So guys, next year dividend will be 50% of 2.36. So when we are using this formula, you are talking about D1 upon P0 plus G. So we're talking about what is D1. So D1 will be again, next year's dividend, that is 50% into a 2.36. What is the value they've given to you in the question? Yeah, 2.36, right? So that comes out to be 1.18. And of course, the price is given to you. That's 23.6, I guess, right? So 23.6. The question is, what is G, guys? What is growth rate? Now, if you look at the question, they've given you the trend of EPS for the preceding 10 years. And if you can see, every year there is an increase of 10% over there. 1 to 1.1, 1.1 to 1.21. Every year, see the last 3 years also, they have a trend of 10%. So let's take G, that means 10%. So from the previous years. So what we calculate here is 1.18 upon P0, 23.60 plus you're talking about 0.10. So what does that comes out to be, guys? 1.18 divided by 23.6 plus 0.1. So that gives you 5 plus 10, right? So we're talking about a 15%. 15%. So basically we calculated in this case question number A, that was the requirement for us, the question number A, which talks about the calculate after tax the each component. Now question number B talks about calculate the marginal cost of capital when no new shares are issued. Guys, that's very, very straightforward. Marginal cost of capital when no new shares are issued. What is the question asking us? I just explained you, when we are talking about no new shares are issued, then we are talking about, in this case, marginal cost of capital will be nothing but WACC. So we just have to calculate WACC, guys. So in this case, what is the capital structure with us, right? So let's see what is the optimum capital structure. I guess that was given to us, right? So when we talk about the optimum capital structure, they had given to us a 30,000, 10,000, and 1,60,000, right? So that's what given to us. 30,000, 10,000 and 1,60,000. So let's apply that weights onto the individual structure, individual cost of capital component. So we talk about KD, right? What was the first one? 8.33. So 30, 10 and 1 lakh 60. So that's 2 lakhs, right? It's 3 upon 20 into 8.33%. Similarly, next we calculate as a 10,000 upon 2 lakhs. So 1 upon 20 into 12% or 11.96. That's okay. And then we are talking about 15% multiplied by your 16 upon 20. So we have three different components. We have just applied the weight, and that should come to roughly around 13.8%. Okay. So that is option number B, guys. So let's talk about next part of this question, that is question number C. Determine the amount that can be spent for capital investment before new ordinary shares must be sold, assuming that retained earnings for the next year's investment are 50% of 2019. So guys, what do we do about that? What are they asking us? They're asking that before additional issue is required, what do we need to do? So of course, we need to ensure, that means before additional issue is required, now you need to ensure that you maintain your original capital structure, 3 is to 1 is to 16, right? Now retained earnings, now if I let me just actually take you to the question again. Okay, it's make more sense. We look at the facts once again and then we try to solve it together. Okay, so the call of the question is, I'm looking at question number C here. Determine the amount that can be spent for capital investment before new ordinary shares must be sold. Okay. And they've given assumption that retained earnings of the next year's investment are 50% of 2019. So what are the amount which are 50% of 2019? So again, we need to understand that retained earnings which are given to us 50%. So how do we calculate that, guys? 50%. So they're given us, if you see company as a share market, next year dividend price is 15% of 50% dividend per share of year 2019 EPS. So earning per share is 2000 for 2019 is 2.36. 50% is the dividend. So that means the rest of the 50% are we talking about as a earnings here, right? So we're talking about a 50% of 2.36. So that is 1.18. And how many number of shares? See at the top, 10,000 shares. So that means looking at this 50% of that. So 2.36 multiplied by 50% multiplied by 10,000. So that's the amount of retained earnings, right? So retained earnings, that means are basically 11,800, guys. 11,800. Now that's interesting. Now we're talking about if my retained earning is 11,800, and if I'm looking at the call of the question of C, determine the amount that can be spent for capital investment before new ordinary shares must be sold. So guys, my question is, if I want to plow back 11,800 here, so if I have to plow back 11,800 as retained earnings, I hope you understood how we arrived at 11,800, because dividend was 50% of this. So the rest is your retained earnings. So 1.18 into 10,000. Now that we have to ensure that that is a ratio of 3 is to 1 is to 16, right? That's the ratio we are having. Retained earnings is part of the equity, guys. So that means 11,800 would be 80%, and rest of the 20% will be additional debentures and preference shares, right? So that means 11,800 divided by 80%. What is that value? 11,800 divided by 80%, that gives you 14,750. So till the point you are spending 14,750, you need a capital of 14,750, you are maintaining the same capital structure, you don't need additional equity, guys. 14,750 is your answer, guys, here in this case. So we need to understand, basically what we're trying to say is that yes, we need to understand that before you are raising more capital, you are maintaining 3 is to 1 is to 16, and we know that your retained earnings from that perspective is what are the retained earnings. So that is something which we very well know is again We are talking about 2019 15%. So that part is something we need to be pretty much careful about when we are calculating that, what are the different sources there, right? So let's quickly go to the whiteboard then, and we are talking about that here. Just a second. Yeah. So we're talking about the question number C in that case. So we are talking about keeping a capital structure of 3 is to 1 is to 16. Let's talk about what is the retained earnings. So we're talking about no equity, right? So 50% of EPS of 2019, so 1.18 multiplied by number of shares, 10,000, that is your 11,800. And since our retained earning is part of the equity, guys, so make sure that we don't kind of make any error over here. So that is your 16, so 80%. So if my 11,800 is my 80%, so what value will be my x, will my 100% here, right? So my x will be 11,800 divided by 80%, and I guess we calculate that as a 14,750. So that means for additional investment of 14,750, that simply means for additional investment of 14,750, your 11,800 is coming from retained earnings, or you can see equity, and rest of the stuff, that is your 2950, of course it's coming from your debt and your preference share, right? That's the other point you're talking about, right? Debt and preference share, exactly. So debt and preference share is, so now if you need funds more than 14,750, by the way, so that means if you need funds more than 14,750, that means you are going for a new issue of equity, because you don't have any more retained earnings with you. So that's the key point to understand the marginal cost of capital. In this case, guys, in this case, I need to remind you that exactly where we talk about that particular point, right? So let me just showcase that graph again to you when I was explaining you marginal cost of capital. This is the point, guys. This is the point. So maybe till 14,750, your cost of capital is not increasing, but after that, your cost of capital will definitely increase here, right? So let's look at the last question then. What's the last question? And this is taking some time, but this is a good question worth spending some time. Compute the marginal cost of capital when the funds exceed the amount calculated, right? Now the point is, you're saying more than 14,750. So you need now the new equity is issued at 20 per share. So that means now we need to calculate the marginal cost of capital. That means in this case, if I have to calculate option number D, I need to be careful about, in this case, my KE will change. My KE will change, guys. Now, in this case, when I go to option number D, let's look at what was my KE earlier. 1.18 upon 23.6 plus 0.10. Now, in this case, my KE, again, my KE was, what exactly was that? 15%, right? So this was my 15%. So this was my 15%. Now, in this case, what happens? I'm going for a new KE, for a new issue. So that's what the requirement, right? So in this case, what will be the value? D1, that remains same, 1.18. Denominator changes from 23.6 to 20, guys. And then of course, your growth rate is there. So I'm sure that will be more than 15%, pretty much sure, but let's calculate still. So it comes to 15.9%, guys. Now, because KE has changed, I have to calculate a new WACC. Remember, the call of the question was, if you again go through, we're talking about a call of the question that in case your amount is in more than 14,750, the amount calculated more than C, or what will be the marginal cost of capital? And the marginal cost of capital we have already discussed is your weighted average cost of capital. So your other factors remain same, by the way, right? So you have a same ratio, by the way. So when we're talking about maintaining that, so what shall be our value? Now in this case, we need to know that 3 by 20, 1 by 20 and 16 by 20 will be my weights, and the other components of the cost of capital, there is no change here unless and until we are given some additional information, we may have to calculate them that as well. So having said that, so 3 upon 20 into 8.33 plus 1.20 into 12, I guess that remains same, right? And then you are talking about a 15.9, that is your 16 upon 20 into 15.9. So that would again, remember, let me just highlight that also. My cost, weighted average cost of capital was coming out to be 13.8, guys. No new shares are issued, 13.8. Let's see how much now we are calculating here as part of the D1. So if you multiply this 3 upon 20 into 8.33, 1 upon 20 into 12 plus 16 upon 20 into 15.9. So we'll get roughly around 14.6% as compared to 13.8 at the top. So you can see what happened. Earlier, my weighted average cost of capital was 13.8. Now it has gone up to 14.6%, because the reason is that you had to issue a new capital here, new equity here. I hope now you understand what I'm trying to say, the importance of the weighted average cost of capital in the terms of additional equity issued, better known as marginal cost of capital. So let us go back to our presentation to again go through that concept so that it is crystal clear to you all. So it's again to calculate the marginal cost of capital. I'm looking at the point number 2, mind you. The intended financing proportion should be applied as the weight. So the intended financing proportion in our example was 3:1:16. And when a firm raises funds in proportional manner and the cost remains unchanged, there will be no difference between the WACC and the marginal cost of capital, because that was the point till 14,750, mind you. But after that it will start increasing, hence proved. So I hope you guys understood that example. If not, I would request you to kind of solve that on your own. I'm sure you should be doing good. Okay, so you can definitely have those workings with you, and I'm sure this will be pretty helpful to explain the concept of marginal cost of capital to you all. Okay, so let's try a couple of brain teasers here. We're talking about which of the following cost of capital require to adjust tax. We know that, right? We know that it's your interest, right? Interest on debentures. So option number C is absolutely right. So that's one. That's a easy peasy for us. So those are the questions you expect in the exams. Definitely not. Why not? So the following details. Moving on to the question number 2. Following details are provided by Pentamit Limited. Equity shares 50 lakhs, 12% preference shares capital 15 lakhs, 15% irredeemable debentures. The cost of equity share capital for the company is 16% and the income tax rate is 30%. So you have to calculate the WACC here. So guys, what is the WACC? So we need to calculate, so what is the capital structure here? 50, 15 and 35. And they're talking about the cost of equity capital given to us and income tax rate. So we're talking about a 15% irredeemable debenture. So we just calculate. So it's easy busy, right? So we're talking about a cost of equity that's given to us as a 16%. Income tax rate is 30. So your 15 into 70 is your 10.5, right? So that's a 10.5. This is 16, which is given to us. And your cost of preference is already given to us as 12. So we just have to multiply these by the weights. That's your 50, 15 and 35. So you get your cost of equity as 13.48%. I think you should be by now be champions of calculating the weighted average cost of capital, because we have spent good enough time in calculating individual cost of capital. Not only that, but also weighted average cost of capital. Even we went beyond an extra mile to understand what's the marginal cost of capital, right? So I hope the concepts are pretty much clear. You have to do some deep diving into the concepts, read through your study material, practice more questions, look at the past year questions. I'm sure this should be pretty much in good shape, guys. Okay, so now let's move to a couple of more practice questions, and let's try to brainstorm whatever understanding we have done in this session till now. Now, again, ABC Limited is having some book value capital structure. It's given to us. Debentures are redeemable at par after 5 years and are quoting at 985 per debenture, guys. And the current market price per equity share is 60. Prevailing default risk-free interest rate on 10-year government of India Treasury bond is 5.5. Average risk premium is 7%. Beta of the company is 1.85. Preference shares and the applicable rate is given, and they're just asking you the weighted average cost of capital using the market value. Guys, this you can do, right? This you can definitely do. So you know that we're talking about that debentures are redeemable after 5 years and quoting at 985. So we know that the value, we need to calculate the redemption value and the net proceeds, and the difference have to be spread out between the 5 years value, and obviously the denominator will be the average value over there. However, the current market price for the share is 60 and the prevailing default risk. So what do we calculate here? Given the, so we are expecting to use a CAPM model here, right? And also the preference shares as well. So what are the weighted average cost of capital? So guys, you need to do note to the KE. We need to have a KR, we need to have a KP, we need to have a KD. Not only that, we have to take a cost of long-term loan as well. So let's try to understand one by one. So we calculate cost of debt first, right? So we talk about this as our interest factor. So we talk about the 8.5 debentures, 8.5%, that is multiplied by 1000. So that gives you 85. So 85 and net of tax, and your maturity value is 1000 and the current value was 985. So the difference spread out to be over 5 years. That divided by 2 is your 5.87. That's pretty much simple. The long-term loans, which has given to us 12%. So this again is similar to your debt. That's what we're talking about. So your 12 into 1 minus 0.35. So that's 7.8%. So I hope this is pretty much straightforward here. But yes, in terms of the cost of preference shares, again, that is also a redeemable one. The only difference is, of course, they are not having a tax deductibility. So 9% preference share. So 9% into 100, that's your 9 here. Now, redemption value, by the way, that is given to us in the question that your preference shares are redeemable at 10% premium. So RV in this case would be your 110. And again, the current value is 102. So that's RV minus the current value. So that's what 110 minus 102 divided by 5. That gives you a cost of preference share as 10%. And the KE, the most crucial one, the CAPM, you know what is RF. Mind you, they've given you the average market risk premium. They've already given you RM minus RF. So we're talking about 5.5 plus 1.85 into 0.07 or 7%. So whatever you want to calculate. So you just have to straight away calculate 5.5, 1.85 into 7 gives you 18.45. So the most important factor, which I told you earlier, they've already given you market risk premium. That's RM minus RF, guys. That's already given to you in this question. So please don't do a mistake that you again reduce a 7 minus 5.5. Howsoever, if I may ask you, what is the market portfolio return? What is the market portfolio return? Can you calculate? Why not? It would be your RF. Again, what they have given you, right? So in this case, they have given you RM minus RF, right? That is given to us as 7%. So that means RM will be 7% plus the free rate of return, that is 5.5. Although not required, but I'm just explaining you that RM, if they would have given you RM, they would have given you 12.5, but they have already given you the market risk premium, that is RM minus RF. So please don't do that mistake. Okay. So now you calculated all the four components, KD, long-term loan, KP, KE, and we know that we also needed KR, but we can club that as part of the equity. We discussed KR is equal to KE unless we're talking about a new equity issue here. So you can see that market value in this case for the equity though, and this is the point I told you, we talk about using the market value weights, and the book value of the equity is 3250. But whereas when we talk about from a market value perspective, current market price per equity share is 60, right? So we're talking about a 1 crore shares. So that means in lakhs, we're talking about a 6,000. Then we are talking about the preference share. So we already have the current price of the preference share. However, in the term loans, of course, it will be the same value that is given to us. That is, there is no market value. Of course, it's the value which is the to be returned as is. That is your 500 lakhs here. Now that means the most important point is that you may be wondering where is retained earnings here. Now we need to understand when we're talking about retained earnings, that's a part of equity here. That's the part of the equity, right? So when we're talking about market value weights, let me just go back to a concept which I was explaining you earlier as well. Okay, let's try to understand a concept which I was talking about earlier when we're talking about the retained earnings though. Okay, see this, the note here. Weights can be based on book value of the individual components or based on the market value. So market value of the equity can be proportioned basis the book value of the paid up equity and RE. However, we did not do that. We did not do that. We don't need to do that because K and KR is same, right? So what they are trying to say here is that they are giving you straight away in this particular question, equity market value 60. So 60, again, that's what they are given to you, right? So this is in this question they have straight away given to you. So 60 into 1 crore is 60 crore. 60 crore. You can split that in the ratio of the book value, but we don't need to do that because KR is equal to KE here. So I'm just explaining you out of the context, out of the requirement, so that you are aware that, in case you are required to split that into KR in and the KE, you can split the market value as well, because had KR and KE was different values, you may have to require to do that. So you have to calculate the weights here based on the market value. I think that you can do, and you multiply these cost of capitals to arrive at a 15% WACC here. Okay. So, okay, let's try to look at one more question maybe, and then we'll call it for the day. So Mogambo Limited wishes to raise additional finance of 10 lakhs for meeting its investment plans. It has rupees 2,10,000 in the form of retained earnings available for investment purposes. Further details are given: debt to equity, cost of debt, and they've given cost of debt up to 1,80,000 as 10% and beyond 1,80,000 16%. So you have to be careful on that point. EPS is 4, dividend payout is 50%, expected growth in dividend is 10, and they're giving you market price and the tax rates, etc. And they're talking about to determine you're required to determine the pattern for raising additional finance, determine the post-tax average cost of additional debt, cost of equity, cost of retained earnings, and to compute the overall weighted average tax after tax of the additional finance. So I think it touches based upon the additional financing, because in the additional financing your cost can be different. We talked about at length on that. So I request each one of you just take a snapshot of this question and let me just take you to the whiteboard and let's solve this together. Okay. So this is an interesting question though, although we have discussed some similar questions here, but let's walk through on this one as well. Okay. Okay, so first question here is to determine the pattern for raising additional finance. So guys, my point is that the first line was the company limited, the Mogambo Limited wishes to raise additional finance for 10 lakhs, right? So what would be the pattern here? That's what they're talking about, right? So now my point is that the debt equity is given to us, right? 30s to 70. So if you're talking about question of Mogambo Limited, so they're given to you a debt is to equity, right? That's what given to us. That is given to us is 30s to 70, right? And they're talking about a pattern for 10 lakhs. So that means in this case, the debt would be your 3 lakhs and equity would be 7 lakhs. Now we need to understand that, when we talk about equity, that includes your retained earnings as well, right? So that includes your retained earnings as well. So, and the retained earnings is already given to us in the question as 2,10,000, right? So if I talk about my retained earnings as 2,10,000, that means my equity shares as a balancing figure of 4,90,000, right? Because I have a requirement of 10 lakhs. So that means it will be a 4 lakh, a split of 4,90,000 and 2,10,000. Now, having said that, remember when we look at the debt of 3 lakhs, even here, my composite, structure of the debt, because there is a cost of debt split into two parts. So that means 1,80,000, right? That's up to, we're talking about a 10% debt, and 1,20,000 because any debt over and above that was a 16% debt. So that will be the part of the question number A that's talk about the pattern for raising additional finance. So I hope you understand from which sources I am raising my additional finance. So I've just applied my debt equity ratio into 10 lakhs. I split that into debt and equity. Equity includes retained earnings, and the balancing figure is the equity shares, and then the debt also splits into 1,80,000 and 1,20,000. Okay, so I hope that makes sense to everyone. Now let's move to the question number B. Then it says to determine the post tax average cost of additional debt, cost of equity, and cost of retained earnings. Post tax average cost of additional debt. Now we need to understand that what is my cost of debt. Otherwise, if you're talking about 10% debt, and we are already given in the question that there's a tax rate of 50%, by the way. So my point is, for the 10% debt it will be 5%, and for the 16% debt it will be 8%. I think that is straightforward, right? Now the call of the question is post tax average cost of additional debt. Okay, so average cost. So again, we know in this particular question, so let's use a different color for this. Post tax average cost, right? Just give me a second. Yeah. So KD for a 10% one will be actually 10 into 1 minus T. That will be a 5%. And KD for a 16% similarly will be your 8%, right? So the core of the question is post tax average cost of additional debt and cost of equity and cost of retained earnings as well. Now, so that means in this case, we need to understand that we are using this 1,80,000 and 1,20,000. So that means proportion is 3 is to 2, right? So 3 is to 2 is by proportion. That means 5% into 3 by 5 plus 8% into 2 by 5. So that will be 3% plus 3.2. So we are looking at a 6.2%. So post-tax average cost of debt is 6.2%. But mind you, that was not the only question. It was cost of equity and cost of retained earnings as well. Now, cost of equity and cost of retained earnings, we know that's the same thing here. Now, which model we can use to calculate the cost of retained earnings? So if you look at the given information, they have given us the expected growth in dividend, EPS, dividend payout. So I think that is interesting, so that we can use the formula, right, for KE, that is your D1 upon P0 plus G. So that's the formula we can straightforward use here. Now, what is D1? So dividend, EPS is 4, dividend payout ratio is, my D0 is 4 into 50%. That's 2. So D1 will be 2 multiplied by growth rate, right? 1.10. So 2.20. So my cost of equity will be 2.20. They've given you a P0. That's your current market price, I guess, right? So current market price is 44. And that's your G. That is your growth rate of 10%. So that means 15% will be my cost of equity, or also the cost of retained earnings. So that's complete my question number B. Remember, it was not only average cost of debt, but also the equity and retained earnings. So in this case, we're not going for an additional equity here. We're not going for a new issue of equity. Otherwise, it could be KE would be higher for that. So KE is equal to KR. C question, last question was to compute the overall weighted average after tax cost of additional finance. So I think now we know that it's again a 70 is to 30. We know that pretty well. So it's pretty easy busy. So last one is pretty easy busy. So 70 is to 30 is the proportion we already knew that we use in the first impact as well, or 30 is to 70, however you want to look at. So if I use 70 as a equity, that's a 15%, and 30 upon 100, we already have an average debt. I think average debt was 6.2%, guys. So if we use that as a number, we should be getting as a 10.5 plus 30% of 6.2. What is that? 1.86, right? So that will be giving you a 12.36%. So perfect, guys. So that is the all the three parts then of this particular question, and I'm pretty much sure you guys got a hang of it. How do we calculate the individual components? How do we calculate the weighted average cost? We have done good enough practice today, so I'm sure that this will help you to make a jinx of the entire chapter, and you will be in a good position. So let us quickly see and cross check our answers there. So we calculated your pattern for additional raising finance. So we talk about that 2,10,000 and 4,90,000 post tax average cost. We talk about the 6.2, and we talk about the overall weighted average cost of 12.36%. So guys, I think that was interesting. I really, I'm sure that you really benefited out of this session. And see, the simple request is that there is no shortcut to success, guys. So always remember the hard work, discipline, and dedication that never goes in vain. We spend good enough time to understand each component of the cost of capital, the weighted average cost of capital, the marginal cost of capital. Very important chapter, as I said. Cost of capital will be using your as a hurdle rate in investment decisions as well. It will talk about also in the working capital management as well. So this will be a very, very important laying down foundation for you. Also, an optimal capital structure depends on whether you want to minimizing the cost of capital. Whatever learning we have done during this session, I'm sure you will take best out of it. Last question I want you guys to give for homework. Please attempt this question yourself, and I'm sure you can check your answers with the presentation. And I wish you all best of luck. It was fun, just like other sessions, and I'm sure you would go back, read the study material, practice a lot from the past year exams, do practice for all the study material questions on RTPs. I'm sure you will definitely rock and roll. Be careful to the small details and be attentive to the call of the question. That would be my advice for you all. With that, I would take your leave for and will definitely look forward for the various sessions to come, specifically the investment decisions next week, and then followed that by the working capital management. So we'll have very, very interesting times together. I'm pretty much sure I will enjoy your company, and I'm sure you guys will definitely do the same. Take care, guys. Have a good days ahead. Please study hard, keep studying, and please be safe as the things are worsening out with the second wave. So I'm sure we will definitely meet again soon. Take care, guys. Best of luck.